What if your job you love the most becomes your source of income? And if your soul, your energy, and your entire way of thinking are dedicated to that work, then you will not do it just as work every day, but as a discipline. This same thinking applies to trading. But as soon as you only chase money, you fall victim to fear, greed, restlessness, and comparison. For those whose why is strong, the how finds its own way. The author says, passion is not just excitement. Passion is that deep feeling of connection that gives you continuity. When you connect with your why, discipline, patience, and focus are automatically created. Next, let's talk about the most important element that turns passion into a fire, and that is clarity. If you don't know what you want to do, what strategy to follow, what time frame to work in, how much capital to start with, then passion turns into a wandering fire. The author has divided this clarity into 3 parts. Vision clarity. What kind of trader do I want to be? Strategy clarity. What system or rule-based method will I follow? Vision clarity. What system or rule-based method will I follow? This saves you from the current that pulls every new trader down. For this, it is necessary to avoid changing systems, making emotional decisions, and sacrificing your vision. Now, a deep thought. Passion is incomplete without purpose. Passion gives you fire, but purpose gives it direction. Purpose doesn't just mean a big vision. Purpose means, why do you sit in front of the screen every day? What kind of value are you creating? Are you just trying to catch a trend, or are you improving yourself a little bit every day? If your goal is financial freedom, then the purpose should be that you are making your habits worthy of that freedom.
Now let's move on to the next practical truth. Passion does not work alone. It needs structure. Structure means a framework where you repeat your daily tasks, thoughts, preparation, and implementation with discipline. The author says that if passion is a wild horse, then structure is a rider who directs the horse's energy in the right direction. A basic outline of a structure can be reading your trading journal for 15 minutes every morning, following a 3-point checklist before every trade, mentally resetting after every loss, back-testing your strategy on every weekend. All these things may seem boring, but this is the discipline that transforms an emotional but directionless trader into a focused and consistent trader. Now let's talk about the biggest war that goes on inside an emotional trader, and that is ego versus purpose. When you win repeatedly, the ego says, "Look how good I am." Purpose says, "I have come here to learn, not to win." The ego says, "Every loss makes me better." Purpose says, "I observe the charts. I don't control them." When you are driven by ego, you try to save your identity. But when you are driven by purpose, you expand your abilities. The author repeatedly emphasizes that trading is a journey of self-awareness, not just financial gain. And when this is ingrained in your heart, you start catching yourself instead of catching the trend. This chapter does not stop here. It has one more final component, and that is the belief system. What you think directly guides your trading. If you believe that the market is unreliable, your behavior will be defensive. If you believe that the market is a teacher, you will look at every signal with curiosity. Therefore, every emotional trader should do a deep self-examination of their belief system.
Do I consider trading a struggle or an opportunity? Do I consider myself capable or lucky unlucky? Do I trust the system or do I try something new every time? Your passion will only be strong when it is connected to the right beliefs. Chapter 1, Part 2. Now we are talking about the most subtle yet most important element, energy. Your energy determines the quality of your trading. If you sit in front of the charts but your mind is somewhere else, if you're physically in front of the screen but mentally distracted, you will not be able to see the market. You will only see candles, you will see patterns, but you will not get clarity. Passion resides where both energy and focus are aligned. The author says that every trader should understand their energy cycle. At what time are you most alert? When is your decision-making ability at its peak? At what time do you get tired and make emotional decisions? Your performance does not depend on how many hours you look at the charts, but on how many focused trades you take during your highest energy time. Now let's talk about the misconception that harms many emotional traders: overcommitment. Passion does not mean that you have to be in the market all the time. Passion means that when you are there, you are fully present. Overcommitment leads you to fatigue, and after fatigue comes confusion, then comes disappointment, and then comes revenge trading. So it is important to make passion sustainable. This requires rest, reflection, and rhythm. Every emotional professional takes a break in the middle of their work. If there is no pause in music, it turns into noise. Similarly, if there is no self-reflection in your trading, your clarity will be drowned in noise.
Now let's come to a concept that is probably the most undervalued: joy. The author says that if there is no joy in your trading, it will soon turn into stress. Joy doesn't just mean being happy in a winning trade. Joy means finding joy in the process. When you can accept even a loss as a learning experience, when you are filled with curiosity while analyzing, when you have a conversation with yourself while writing a journal, there is joy. Joy is the fuel for long-term consistency. Passion and purpose only become meaningful when you look at the charts every day with the desire to learn something new. Now let's talk about alignment. Passion has energy, purpose has direction, but alignment is needed to bring these two together. Alignment happens when your time management is favorable for your trading, your personal goals and financial goals support each other, you are implementing what you are learning and learning what you are implementing. He asks, have you ever thought about what emotion you are chasing in the market? Are you trading for excitement? Are you trying to do better than others? If so, your trading is revolving around external validation. But when passion and purpose are in the right place, validation comes from within. You do not judge yourself, you observe yourself. Finally, the author talks about an extremely powerful habit: intent setting. Before every trade, tell yourself a sentence: today, I am trading for clarity, not for excitement. Or, today I will read the charts, I will not control them. These small sentences can change the course of your trading. Chapter 2, Part 1. If you have a fragile or inconsistent mind, even the best strategy will break down. Mindset can be understood in dividing it into 3 parts: belief system, emotional regulation, and decision-making discipline. The first is the belief system, which determines how you view the market, how you perceive yourself, and how you define success. If you believe that the market is always unreliable, you will always trade in fear. If you believe that you are always missing something, you will trade emotionally. But if you believe that the market offers infinite opportunities, but I only act on high-quality setups, then this belief will keep you calm, confident, and protect you from overtrading. Changing the belief system is not easy, but it can be rewritten through daily affirmations and journaling. For example, I don't run after trades, I wait for them. Or, loss is not a failure, it is just a feedback. Now comes the second part, emotional regulation. Many people think that suppressing emotions is control, but the author says that observing emotions is the real control. Every wrong trade has some emotional reason behind it: irritation, revenge, overconfidence, anxiety. The easiest way to understand emotions is to take a pause.
A 5-second pause before every decision shifts you from the emotional brain to the logical brain. Your mind is like a muscle. If you train it to stay calm every time in moments of emotion, it will gradually react the way you have trained it.
The third part is decision-making discipline. This means, do you always implement your trades with defined risk? Have you already set clear entry and exit points? Do you not take revenge after a loss? And most importantly, do you not trade out of boredom? This discipline is created when you see trading not as a means of emotional release, but as a well-organized habit. The author makes a very sharp comparison here. A doctor only performs surgery when the patient needs it, not when the doctor is bored. Similarly, a trader should only trade when there is a setup, not when their mind wants to. The next step of mindset mastery is detachment. Detachment means abandoning attachment to the results, but maintaining commitment to the process. When you try to win every time, loss breaks you. Detachment frees you from fear, greed, and ego. Now let's talk about the deep fear that resides within every trader, the fear of not being enough. This fear forces you to seek proof repeatedly. A win, a big profit, praise from others. But a purpose-driven trader does not need any proof. He knows that growth is an invisible process which appears late on the surface, but a lot is changing inside. To build this mindset, the author talks about a simple but deep ritual. Reflect, don't react. After every trade, ask yourself 3 questions. Did I take this trade based on my system or based on emotion? Did I follow the risk management rules? Would I want to repeat this trade regardless of the outcome? When you ask these questions every day, your brain makes them a default, and these default decisions form the basis of your consistency. This chapter concludes with a powerful reminder. Your ultimate advantage is not a strategy, an indicator, or a guru's advice. Your real advantage is your mindset. And this mindset is built every day through small wins, losses, and self-observation. The game of trading is not played on the charts, but in the consciousness.
Chapter 2, Part 2. Now that you have understood that your real advantage is your mindset, not some magic indicator, it's time to develop the most difficult but most important skill, which is called self-awareness. The author says that a trader's greatest strength is not his strategy, but the ability to observe himself in real time, without judgment. Self-awareness means you can see your thoughts, emotions, and behaviors from the outside, just as you would see another person. When you start recognizing your inner patterns, you get the power to change them. Every time you overtrade, there is a reason for it. Every time you exit a trade in fear, there is a thought behind it. Every time you jump in due to FOMO, fear of missing out, there is a belief behind it. Self-awareness means being able to directly identify that reason, that thought, and that belief. For this exercise, the author talks about a practical tool, micro-journaling. Micro-journaling means you will stop for just 1 minute, 2 to 3 times a day, and write, "How am I feeling right now? From what emotion did the decision I made come from? Am I seeing from clarity or from bias?" These small self-examinations take you out of your mental blindness and toward conscious action. Now let's talk about internal dialogue, that is, what you talk to yourself. If your inner voice says, "You make mistakes every time," or "You can't be disciplined," or "If this opportunity is gone, everything is over," then understand that you are fighting against yourself. But if your inner voice says, "I am trying to follow my system. Every trade is my teacher. I am focusing on the process, not the outcome," then you become a supportive trader for yourself.
Self-awareness teaches you that trading is not just about executing a strategy, but the art of balancing an internal environment. Now, let's talk about something that forces millions of emotional traders to leave the market: self-sabotage. Self-sabotage happens when some part of you does not allow success. For example, you traded well for 3 days, and on the 4th day, you made a loss without a plan. You learned the strategy but did not apply it. You created discipline but broke it yourself. This destruction often comes from subconscious beliefs such as, "I can't be consistently successful," or "It's going so well, now something will go wrong," or "I have to prove myself every time." The author says that self-awareness is the most effective tool to catch and stop this destruction. Now we come to another important concept: state management. State means what mental and emotional state you're in: calm, focused, anxious, distracted. Every state works like a filter. If your state is fear, the market will seem scary to you. If your state is clarity, you will see opportunities objectively. Therefore, a trader's daily goal should not just be to make money, but to maintain a stable, strong mental state. There are some effective ways of state management: taking 2 minutes of deep breaths before trading, setting positive intentions, reading a trading journal, imagining, where you imagine yourself trading calmly, and most importantly, taking breaks in time so that your state is refreshed. Maintaining a state is as important for long-term advantage as a good setup. Finally, the author says that self-awareness is not a one-day job, it is a lifelong habit. Every time you start to take an emotional trade but stop and pause, you develop yourself. Every time you look at a loss analytically instead of taking it personally, you improve. Every time you ask yourself, "What am I feeling?" you regain control. And when this self-awareness becomes consistent, you can make decisions peacefully, even in the chaos of the market. This chapter not only prepares you for trading, but it also prepares you to build a deep relationship with yourself. Because in the end, the biggest challenge in trading is not the charts, but managing yourself.
Chapter 3, Part 1. Now that you have understood the power of self-awareness, the next step is to turn it into consistency. Because it is easy to do well in the market for one day, but keeping yourself at the same level every day, that is the real skill. Consistency does not mean that you will keep winning every day. Consistency means that you will keep doing the things every day that lead to winning, no matter what the outcome of that day is. The author says that consistency is not a talent, it is a discipline which is created by a combination of a system, habits, and mindset. So the first step is systemization. You have to turn every aspect of your trading into a system. What are your entry rules? How are the exit rules determined? How much capital should be invested in a trade? At what time should you not trade? In what situations will you take a break? When all these things are written down in advance, your brain does not guess what to do in the live market, because you have already defined everything. Now let's come to the second pillar of consistency, habits. Behind the success of every successful trader are some habits that they follow every day, whether the market is falling or rising. Meditating for 10 minutes before the market opens in the morning. Spending 1 day a week only reviewing trades, no new trades. Taking a mandatory break after a loss to avoid emotions. Do not consider these habits boring. These small patterns create the bridge of big consistency. Now the third aspect, mindset anchoring. The market shows you a reflection of your fears, greed, and restlessness every day. So you have to create some mental anchors that will bring you back to that state. For example, before taking a trade, say to yourself, "The market is neutral, so I will remain calm." Or, "My mind is my reflection, so I will think clearly." These anchors keep you in the place from which consistency is created. People often find consistency boring, but the author says that consistency is the path through which freedom comes. Because when you are predictable, your future also becomes predictable.
Now, a very practical thing: metrics and feedback. If you don't track, you can't improve. Ask yourself every week, How many trades did I take based on the rules? How many times did I break risk management? On what day did I make emotional decisions due to emotions? From what trade did I get the most clarity? You can write this feedback in a spreadsheet, notebook, or a dedicated app. These are not just numbers, they are mirrors that give you the true picture of your progress. Now let's talk about the biggest obstacle to consistency: distractions. Distractions are not only external, such as WhatsApp, Telegram, YouTube, or Instagram alerts. Distractions are also internal, such as boredom, self-doubt, expectations, guilt, and performance anxiety. There is only one way to deal with them: routine and rituals. Routine gives you structure, and rituals give you purpose. For example, reading the system for 5 minutes before starting trading can be a ritual. Writing a 3-point reflection after a trade can be a ritual. Reviewing the last 5 days' charts with a cup of coffee every Friday can also be a ritual. Rituals are not boring. Rituals are sacred. They give you that focus and internal alignment that maintains clarity even in the chaos of the market. Finally, the author says, consistency is not a product. Consistency is a character trait. The more you discipline your behavior, the more your self-confidence increases. Self-confidence does not come from a win. Self-confidence comes when you know that no matter what happens, you will be honest with your system. And when that happens, the market also rewards your consistency, sometimes with profit, sometimes with peace, and sometimes with knowledge.
Chapter 3, Part 2. So far, you have learned that consistency is not just a habit, but a mindset. Now it's time to move to the level where a trader has to endure the most pressure, the relationship with risk. The author says a bitter truth here. Most people trade not to make money, but to avoid loss, and this mindset makes them fall victim to defeat. Your success does not depend on how much you can earn, but on how intelligently and comfortably you can tolerate loss. The market is a game where there is uncertainty every day. Here you cannot have complete control over the outcome, but your relationship with risk determines how you react to that uncertainty. So first know, what is risk tolerance? Risk tolerance means how much volatility you can tolerate within your mental and financial limits without breaking down or becoming emotional. Every person's risk tolerance limit is different. Someone gets scared with one loss, while someone remains calm even after multiple losses. This limit is gradually strengthened through experience and awareness. So it is important to create a clear framework for yourself in advance. What is the maximum loss you can tolerate in a trade? After how many consecutive losses in a day should you take a break? What kind of volatility bothers you mentally? In what market situations should you completely avoid trading? The answers to all these questions give you a map that controls your decision-making when the market goes against you. Now the author talks about the most dangerous relationship with risk: revenge trading. When you go out to war with the market after a loss, you think, "Now I will make up for this loss," and this thought pushes you into a deeper hole. Revenge trading is a mental explosion that stands on the grave of logic. The only way to avoid it is through predefined limits and emergency rules.
Emergency rules mean some conditional stop signals that prepare you for a mandatory break. For example, if I take 2 emotional trades in a row, I will not look at the charts for the next 24 hours. If my drawdown goes above 4% in one day, I will only paper trade the next day. If I feel overconfident, I will sit down to revise the system instead of taking a new trade. These rules not only teach you discipline, but also create your mental security. Now, let's talk about the most underrated concept: position sizing. Position sizing is the science that saves your portfolio from a fall. It not only determines how much to invest, but also determines when not to invest. Many people risk 2% in one setup and 10% in another.
This is not inconsistency, but chaos. A skilled trader is one who deploys every trade like a soldier, limited, thoughtful, purposeful. To manage position sizing, you need a fixed percentage of risk per trade, which will be based on your equity. A clear rule on how the size will change in high probability and low probability setups. And most importantly, to reduce the size after a loss, not increase it. Position sizing saves you not from emotionality, but from ego. Now, a question. Do you consider risk a cost or a teacher? Most people consider loss a punishment, but the author says loss is a lesson if you observe it. After every loss, ask yourself, did this loss come from my system's limitations or my lack of discipline? Did I write down the rules before the trade? Did I associate the outcome with ego? The answers to these questions refine your risk management. In the end, the author introduces you to a reflective truth. Risk will always be there. The market will not give you a guarantee. But if you use risk like your teammate, it will not hurt you, but guide you. If your relationship with risk is respectful, it will never surprise you. It will warn you, prepare you, improve you. And when this relationship matures, you start to thrive, not just survive. Because the real professional is not one who fears risk.
The person who understands risk, welcomes it, and learns to dance with it is the truly strong person. Chapter 4, Part 1. Now that you have learned to see risk not as a fear, but as feedback, it's time to talk about the biggest obstacle that constantly holds you back, even if you think you are prepared, and that is psychological bias. The author says that most wrong decisions in the market are not made because people don't know the system, but because they are trapped in their own thought process. Bias means that inclination of your thinking that comes not from logic, but from habit, fear, or old experience. The first bias is confirmation bias. This means you only look for information that supports your belief and ignore everything else. For example, you decided that Reliance shares will go up. Now, no matter what the news says, no matter what the chart shows, you will only see the information that supports your opinion. Confirmation bias makes you blind. You don't go to see the chart, you just go to prove that you were right. To avoid this, always ask yourself, if I had to take the opposite trade of this position, would I still be so confident? The second bias is loss aversion bias. People want less profit, but they don't want any loss at all. So as soon as there is a little profit, people exit the trade. But when there is a loss, they think, let's stay a little longer, maybe it will come back. And this thought makes the loss even bigger. The way to avoid this is to decide the exit rule before trading, and then not make any changes to it, no matter what happens. Third bias is the recency bias. This means your brain gives more importance to recent events. If you've been profitable in the last 3 trades, you feel that you'll always be profitable now. Or if you've had a loss in the last 3 trades, you feel that you can't do anything. To avoid recency bias, practice data-driven journaling. To understand your true performance, you need to look at the summary of your last 50 trades, not just what the last 3 trades are saying.
Another dangerous bias is the overconfidence bias. When people win something, they feel that they have now understood the market. This bias becomes even more dangerous when people start trading with leverage, i.e., borrowing more money. Overconfidence weakens your stop loss, increases your position size, and makes you mentally unprepared for losses. The way to survive this is the review ritual. After every success, ask yourself, did I follow the rules or did luck help? Is what I am doing today something that can be repeated 100 times? Then comes the anchoring bias. This means getting stuck with a number, a level, or an idea and making decisions around it. Suppose you thought that Bank Nifty would go to 50,000. Now, even if it falls from 49,800, you keep thinking it still has to reach 50,000.
And this anchor has destroyed your flexibility. The only way out of this is objectivity. Instead of expectations, have a daily dialogue with the chart. Now the question is, how to neutralize these biases? The author talks about 3 powerful ways for this. Structured checklist. Before every decision, ask yourself some specific questions, such as, have I written down the plan for this trade? Am I being emotional? Is this a strategy of my system or is it instinct? Have I fully accepted the outcome of the loss? Pattern disruption. Whenever it feels like a decision has been made too quickly, take a break, get up, walk, take a deep breath. This breaking the flow helps to break the bias. Accountability system. Have a weekly review with a friend, mentor, or community. When you explain your trades to someone else, you can catch your own biases. The author says that biases don't end completely, but they can be understood and managed. A bias is seen by the one who knows how to observe their own thoughts. So every time you ask yourself, why am I doing this? Is it my clarity or is it my bias? You go up one step. Bias is a part of your psychology, but awareness is your strength. And this awareness transforms you from a reactive trader to a reflective trader, where you win not against the market, but against yourself.